Hello and welcome to MarketSquare, your go-to show for deep insight into business and economic trends. I'm Olaiton Adebayo, and today we are diving into major stories shaping the economy. Stay tuned. Welcome back to MarketSquare. Nigeria's recent economic reforms, including the removal of petrol subsidies, the unification of foreign exchange markets, and the devaluation of the naira, have ushered in significant macroeconomic gains, even as seen as output reels from immediate financial strain. In the fourth quarter of 2024, real GDP growth hit 4.6% year on year, marking the highest expansion in over a decade. During the same period, the fiscal deficit shrunk from 5.4% to 3% of GDP, sustained by revenue inflows. Simultaneously, foreign reserve rebounded to over $37 billion, signaling restored investor confidence. Short-term pain has been severe. The removal of energy subsidies, a move projected to save the government, triggered an immediate economic impact. Fuel prices more than tripled, pushing transport costs up over 50% and leading to widespread disruptions in public services. This pressure ignited protests led by labor unions, culminating in end-bad governance demonstrations in August 2024 that drew thousands into streets and required the spiraling cost of living. Yet, alongside this impact, there are clear early indicators of structural improvement. The government's measures have curbed speculative activity in the foreign exchange market, contributing to a healthier reserves position and enhancing fiscal discipline. This tightening of policy has led to groundwork for sustainable financial reform, particularly as the economy begins to diversify beyond oil. Savings from subsidy cuts have also been redirected back into the economy. FAC allocation surge, enabling states and the local government to reinvest in infrastructure and public services. At the same time, non-oil exports are beginning to pick up, and Nigeria recorded a balance of payment surplus for the first time in years, a sign that the economy is finally renewed external footing. Despite these gains, doubts remain. Civic groups such as Action Aid Nigeria contend that only about half of the anticipated subsidy savings have reached public coffers, fostering a transparency deficit and undermining public confidence in the reform process. The road ahead demands careful policy-driven execution. It is imperative that agricultural and logistic reforms are fast-tracked to combat persistent food inflation. Social safety net must be scaled up, leveraging the World Bank loan aimed at supporting up to many Nigerians, but only if targeted effectively and deployed widely. Institutional capacity must be reinforced to ensure full and accountable remittance of the subsidy savings. Equally important is sustained investment in education, healthcare, and infrastructure to cement the gains from reform. Fiscal and monetary prudence must remain central, reducing rising cost pressures while supporting efforts to diversify Nigeria's economic base. Nigeria now stands at a crucial junction where the immediate pain inflicted by economic restructuring could yield lasting benefits. The government's challenge will be delivering visible improvements, safer roads, affordable food, reliable healthcare, and accessible education to convert microeconomic progress into everyday prosperity. If managed with transparency, discipline, and strong public communication, the short-term sacrifices may well pave the way for a more resilient, inclusive Nigeria economy. While macroeconomic reform aims to stabilize Nigeria's fiscal outlook, digital finance remains a frontier needing urgent attention. In April, Nigeria enacted the Investment and Securities Act 2025, formally classifying cryptocurrencies, including Bitcoin, as securities and placing them under jurisdiction of Securities and Exchange Commission. This marks a significant departure from previous policy that left crypto assets in legal gray zone. The new framework aims to boost investor confidence and promote responsible growth in the digital finance sector. Complementing this legislation, the Central Bank of Nigeria reversed its 2021 ban on crypto-related accounts. Banks are now permitted to open accounts for licensed virtual assets service providers, although they are still prohibited from holding cryptocurrency directly. This dual shift from both the SEC and CBN signifies Nigerians' intent to integrate crypto into the mainstream financial ecosystem. However, regulation cannot stop at policy declarations. It must be followed by consistent enforcement. Authorities have already begun closing down the operations of unlicensed crypto exchange and are collaborating with foreign regulators to track offshore platforms that continue to serve Nigerian users. Despite this effort, enforcement faces practical challenges. Many of these platforms operate from abroad, and users in Nigeria often rely on virtual private networks to bypass restrictions. To effectively close these loopholes, the Nigerian government must deepen its coordination within international law enforcement agencies alongside enforcement. Robust surveillance systems are being established. Both the SEC and the CBN have created dedicated units to monitor crypto market activity. These agencies now collect data from licensed exchange and fintech platforms. They have also subscribed to Chainalysis, a global blockchain analytics provider, enabling real-time tracking of crypto flows into the market. These tools are essential in identifying irregularities and enforcing compliance standards. A central part of this regulatory evolution involves addressing money laundering and terrorist financing risks. In response to the Financial Action Task Force grey listing in 2023, Nigeria has also strengthened its legal and regulatory framework. Virtual asset service providers are now required to conduct thorough customer due diligence, keep detailed transaction records, report suspicious activities, appoint compliance officers, and train staff. These measures bring Nigeria closer to meeting international AML CFT standards and protect the financial system from abuse. Consumer protection has also emerged as a top priority. In January 2025, the SEC updated its digital asset rules to ensure stronger oversight of marketing and promotional activities in the crypto space. Virtual asset service providers must now obtain regulatory approval before using third-party marketers, including social media influencers. These influencers are required to verify the licensing status of companies they endorse and receive official authorization before promoting crypto products. They are designed to reduce investor exposure to scams and safeguard against misleading promotions in the digital space. Internally, regulatory coordination is being improved through a multi-agency working group comprising the SEC CBN, Financial Intelligence Unit, and the Office of the National Security Advisor. This group meets regularly to share information and harmonize their approach to monitoring and managing crypto-related risks such as fraud, terrorism, financing, and tax evasion. The goal is to implement a unified data-driven framework that responds to complexities of the crypto market. On the international front, the SEC has stepped up its engagement with the global bodies, notably the International Organization of Security Commission. By participating in policy discussions and aligning with international standards, Nigeria aims to position itself as a compliant and progressive player in global digital finance. Discussions are also ongoing with foreign authorities to enable cross-border supervision and coordinating enforcement activities. Nigeria has built a multidimensional regulatory architecture for crypto, a system that includes legalization, enforcement, surveillance, AML, CFT compliance, consumer protection, interagency coordination, and international partnerships. This is a substantial achievement, but challenges remain. Technical enforcement is still demanding, especially in tracking offshore operators and curbing user anonymity. Surveillance tools will require constant updates, and AML CFT enforcement must remain aggressive to ensure systemic integrity. The financial sector, comprising banks, brokers, and fintech firms, stands at a pivotal movement institution that adapts by adopting blockchain-based infrastructure, working with licensed crypto platforms, and embedding compliance protocols, could open up lucrative opportunities in payment, remittance, and digital asset custody. Early moves by banks to explore crypto custody services hint at an industry ready for transformation. Nigeria has laid the groundwork for a secure and inclusive crypto ecosystem. Whether the country's financial system rise to meet the movement or are left behind will depend on the ability to embrace innovation while remaining compliant. Financial regulators work to shape the future of digital assets. The private sector is making bold physical investments. Aliko Dangote is refining Nigeria's industrial and logistics landscape with a bold two-pronged strategy, launching the country's largest seaport and accelerating gas exports. In late June, the Dangote Group submitted official paperwork from a massive deepwater seaport in Olokola Free Trade Zone, Ogun State, approximately 100 kilometers from its fertilizer and petrochemical hub in Lagos. Even as the Lekki Deep Seaport is already establishing itself as a regional logistics center, Dangote envisions the port as the biggest, deepest in Nigeria, enabling streamlined export of urea, fertilizer, and eventually liquefied natural gas, potentially rivaling national facilities like Nigerian Liquefied Natural Gas Limited. This move is also likely to spur broader private sector port investment. The Seaport project complements Dangote's ambition to elevate Nigeria's liquefied natural gas exports. The plan envisions pipelines tapping gas fields from the Niger Delta to Lagos, setting the stage to surpass existing liquefied natural gas exporters. This would mark a decisive expansion of Nigeria's gas infrastructure and its pivot away from imported energy by leveraging domestic resources. On a few fronts, the Dangote refinery, Africa's largest at 650,000 barrels per day, marked a major milestone earlier this year, with plans to ship its first gasoline cargo to Asia. In parallel, the company is constructing 1.6 million barrels of storage for gasoline and diesel at Walvis Bay, Namibia, aimed at supplying southern African countries including Botswana, Zambia, Namibia, Zimbabwe, and potentially the DRC. Together, this initiative represents a sweeping strategy from optimizing logistics and supporting fertilizer output to embedding Nigeria deeper in international fuel markets. The Walvis-based storage facility not only secure regional supply chains, but also position Dangote as a pan-African energy logistics operator. Combined with its new port, Dangote is fast building a vertically integrated export ecosystem. The Olokola port could transform regional industrial corridors, ease export constraints, and attract investment, provided it overcomes regulatory, environmental, and financial hurdles. Meanwhile, the refinery's global deliveries fill a critical role amid projected declines in European fuel exports to Africa. However, local distribution efforts, including more than 4,000 CNG power tankers targeting domestic markets, may unsettle existing traders. Linking a megaport with the LNG pipeline and global fuel export capability signals a strategic masterstroke. If executed well, it could cement Nigeria's role as a leading exporter of energy and agricultural products, attract significant investment, and catalyze private participation in critical infrastructure sectors. While Nigeria navigates new investment and reforms, the global picture continues to shift. In Asia, China's economy posted steady growth, but numbers reveal deeper structural concerns. China's economy expanded by 5.2% in the second quarter of 2025, marginally lower than the 5.4 recorded in the first quarter, according to the data released by the National Bureau of Statistics. The figure surpassed market expectations and keeps China within reach of its full-year growth target of around 5%. However, data also highlight persistent internal challenges that may shape the policy outlook for the remainder of the year. The headline figure was supported largely by external demand. Export rose by 5.8% year-on-year in June, up from 4.8% in May, as manufacturers accelerated shipments ahead of a key August tariff deadline under the current trade truce with the United States. This export-led growth, particularly in high-tech goods, machinery, and vehicles, contributed to 6.8% rise in industrial output, sustaining economic momentum in the face of global uncertainty. Domestic indicators, however, remain relatively weak. Retail sales rose by 4.8%, marking the slowest pace so far in 2025. Fixed asset investment increased by only 2.8% in the first quarter half of the year. The real estate sector continues to contract sharply, with property investment declining by more than 11% and housing prices continuing their downward path. Consumer price data points to mild deflation, reflecting subdued domestic demand and weak price pressure. This divergence between export strength and domestic softness suggests an uneven recovery. While trade performance has provided short-term support, consumption and investment fundamentals remain subdued. According to market forecasts, third quarter growth may decelerate to approximately 4.5%, with a further slowdown possible in quarter four due to base effects and reduced export order once the tariff reprieve expires. In response, the Chinese government is expected to scale up policy support. A supplementary budget ranging from 700 billion yuan to 4.4 trillion yuan is under discussion ahead of the Politburo economic meeting later this month. Additional rate cuts and liquidity measures are also on the table. This would complement ongoing stimulus efforts, including infrastructure spending, credit easing, and consumer subsidies. However, the scope for aggressive stimulus remains limited. Authorities have signaled concern about potential financial imbalances arising from overleveraging. Current policy direction appears focused on calibrated support, prioritizing structural reforms alongside targeted fiscal expansions. Initiatives under the Made in China 2025 program continue to play a central role in efforts to boost innovation, upgrade industrial outputs, and reduce dependence on traditional growth engines like real estate and exports. Labor market conditions also factor into broader policy equation. Survey data has indicated rising job insecurity and slowing wage growth, contributing to conservative household spending. Policymakers may need to increase social protection and employment support to reinforce consumer sentiment and restore demand-side stability. China's 5.2% second quarter growth confirms a measure of resilience in the face of external headwinds. However, the underlying imbalance, strong external demand, constructed with weak domestic fundamentals, highlight the complexity of the current recovery phase. That's it for today on MarketSquare. Thank you for joining me. See you on the next one.